Our second video from Chapter 5 is about other rules pertaining to the taxation of dividends, that is, other than earnings and profits. First of all, qualified dividends. We've talked a lot about qualified dividends from the point of view of stockholders in Tax 1. Well, we also have some rules at the corporate level that we need to be aware of about qualified dividends. Qualified dividends received by non-corporate stockholders are taxed like long-term capital gains. That we knew from Tax 1. To be a qualified dividend, the dividend must be paid by a corporation that meets one of the following conditions. It's a domestic U.S. corporation. So qualified dividend, if it's a U.S. company, then you're good. Or it's a foreign corporation whose stock is traded on a U.S. exchange. So you could have stock in a foreign company that you bought on the New York Stock Exchange or the NASDAQ. Doesn't have to be the premium exchange. Any U.S. exchange will do. Then the dividend could be a qualified dividend as well, because in order to be traded on a U.S. exchange, the corporation is meeting certain disclosure rules. And that's what they're worried about, is that you get a qualified dividend from a corporation that's not meeting U.S. disclosure rules. IRS has no way of checking up on the corporation. But if you're a U.S. corporation, they definitely do. Or if you're traded on a U.S. exchange, then they do. If neither of those is true, then you have to have a comprehensive tax treaty with the U.S. and an information sharing agreement with the U.S. and approved by the Treasury. So even if you've got the tax treaty and the information sharing agreement, you also have to have Treasury approval to have your dividends qualify as qualified dividends, to get that special long-term capital gain treatment. Also, from the shareholders' point of view, there are some things that we didn't discuss in Tax 1 which are relevant. The dividend to be a qualified dividend, the stockholder must hold the stock for more than half of the 121 days surrounding the ex-dividend date. What they don't want is people buying the stock right before the ex-dividend date and then selling the stock right after the ex-dividend date. They get this qualified dividend in between, and they also have a capital loss in the amount of the dividend. And they could play some nice tax games if they could do that. So they say, no. A full 121 days surrounding the ex-dividend date. So if we call the ex-dividend date day 0, then we're talking about the 121-day period from day minus 60 to day plus 60. So you could hold the stock from day minus 60 to day 0. That's 61 days. That's more than half of 121. So you're good. Or from day minus 30 to day plus 30. That's also 61 days, so you're good. What if you held it from day minus 30 to day plus 27? Oh, no, that's only 58 days. That's not more than half of 121. Quick, go out and buy the stock. So on day 57, 58, and 59, we also own that stock. That's good. We've got it for 61 days in that 121-day period. They're not all consecutive, but that's okay. They don't have to be. If the stockholder holds both a long and a short position in the stock, then I don't care how long you held it, the dividends do not qualify. Long and a short position, long position means you bought the stock and held it. That's the normal way to do it. Short position means you borrowed the stock, turned around and sold it, and now you have to repay your loan by purchasing the stock later on and transferring the stock back to whoever you borrowed it from. That's a short position. That is essentially a bet that the price will fall. So you borrowed it when it was worth $100. You said this stock isn't worth $100. it's worth 80 at best. So you borrowed it when it was 100 and sold it right away for $100 a share. Then you took your $100 per share and did whatever you wanted to with it, but then the stock price dropped to 80. Then when you needed to repay the loan, you went out and bought the stock at 80 and transferred it back to your lender. You made $20 a share by betting on a fall in the price, which turned out to be right. So that's a short position. If you had a long and a short position, I tried to figure out why anybody would do that, and I couldn't think of a reason that that would make sense. It seems like if the stock goes up, your long position makes money, but your short position loses. And if it's the other way, short position makes money and the long position loses. So you wind up just losing an amount equal to the transaction cost. But ask a finance professor, they might be able to come up with a scenario where taking a long and short position in the same stock actually makes sense. I was not able to think of one, and I could ask the finance professor, but I didn't. Anyway, if you do that, your dividend is not a qualified dividend. Property dividends. Rules for taxation of property dividends similar to those for cash dividends. Remember, a property dividend, any asset that is not cash and not the stock of the distributing corporation. Distributions are taxable up to corporate earnings and profits and non-taxable if in excess of E&P. Same exact rule as for cash dividends. And the amount of the distribution is equal to the fair market value of the property distributed, which is also the same rule for cash dividends. But getting that fair market value might be a little trickier. Obviously, the fair market value of cash is easy to determine. If a liability is distributed with the property, the amount of the dividend is the net value. So if you get a tract of land with a mortgage on it, they say, here's your land, and oh, by the way, here's the mortgage on that land. Your dividend is the fair market value of the land minus that mortgage. The liability exceeds the value of the property. So thank you very much. You just gave me an $80,000 tract of land and a $120,000 mortgage. Well, they say treat the fair market value of the property as equal to the liability. In other words, you just got a dividend of zero. $120,000 worth of land, even though it's not really worth that, and $120,000 of debt on that land. Now, when you're transferring large tracts of property with liabilities attached, it's likely that we're talking about a closely held corporation here. So you wouldn't expect to get property with debt attached from your ownership in a publicly traded corporation. But it could happen in your closely held corporation. You might be the sole shareholder, and you transferred it to yourself because you wanted the land. You didn't care that its value was less than the debt. You say, no, I'd rather get this out of the corporation and into my hands as an individual for whatever reason. And you don't care that the debt is a little high relative to the value. Your basis in the property is going to be equal to the amount of the liability. Continuing with property dividend, if the fair market value of the property is greater than the corporation's basis in the property, the corporation has to recognize the gain when the property is distributed. So it's pretty much the same as selling the property from the point of view of the corporation. The character of the gain, generally the same as it would be if the corporation sold the property. So if it's a capital asset, it would be a capital gain. If it's a 1231 asset, it would be a 1231 gain, etc. The property is distributed to a more than 50% stockholder, on the other hand, then the gain is ordinary, even if it was a capital asset that was distributed. Corporation does not recognize loss. So this goes one way, but not the other. You do not recognize loss if the fair market value is less than basis. You only recognize gain when the fair market value is greater than basis. So this is not symmetrical at all. Corporation will reduce earnings and profits by the greater of fair market value or basis. So that's good news. Even though you don't get to recognize the loss for tax purposes, you effectively do get to recognize the loss for E&P purposes. So at least there's that. And of course, that will be reduced by any liability transferred. Let's do problem 38. Heather, an individual, owns all the outstanding stock of Silver Corporation, so she is the sole shareholder. She purchased her stock in Silver 9 years ago, and her basis is $56,000. At the beginning of this year, the corporation has $76,000 accumulated E&P, no current E&P, before considering the effect of distributions as noted below. What are the tax consequences to Heather, which means the amount and type of income and the basis of property received, as well as Silver Corporation, gain or loss and effect on E&P? In each of the following situations, treat each one independently. First of all, letter A, Silver distributes land to Heather. The land was held as an investment and has a fair market value of $54,000 and an adjusted basis of $42,000. Fair market value of the land, $54,000. Silver will have an amount realized of $54,000. Basis was $42,000. So there's a realized gain that will be recognized in the amount of $12,000. Heather's dividend income, $54,000, the fair market value of the property. Heather's basis in the land, also $54,000. Silver's earnings and profit started at $76,000, went down by the $54,000 distribution and up by the $12,000 gain recognized, so they are now at $34,000. Letter B. Silver distributes land to Heather. The land was held as an investment, fair market value of $54,000, basis of $42,000. Assume that Silver Corporation has no accumulated E&P prior to the distribution. So the only change, distribution is exactly the same, but we do not have the $76,000 of beginning accumulated earnings and profit. So Silver, amount realized $54,000, basis $42,000, realized gain is $12,000. That hasn't changed. Heather's dividend income, just $12,000. That's the only earnings and profits that Silver has to distribute, is the realized gain from the transaction, which was the distribution. So Heather does have $12,000 of dividend income, meaning she has a non-dividend distribution of $42,000 because the total distribution was $54,000. Her basis in the land, $54,000. Her basis in her stock, it was $56,000. It just dropped by the amount of her non-dividend distribution of $42,000 down to $14,000. And Silver's E&P, 0 plus 12 minus 12, back to 0. Letter C. Silver distributes land to Heather. The land was held as an investment, fair market value of $54,000, basis of $42,000. That's all the same. But the land is subject to a $46,000 mortgage, which Heather assumes. And we will assume that the corporation, once again, has accumulated E&P at the beginning of the year of $76,000. So Silver, amount realized $54,000, basis $42,000, realized gain $12,000. Heather's dividend income, $54,000 minus the $46,000 liability that she assumed. So she has $8,000 dividend income. Her basis in the land is $54,000, the $8,000 plus the $46,000 liability that she just took over. Silver's E&P started at $76,000, add $12,000 for the realized gain, and subtract $8,000 for the portion of Heather's distribution, which was treated as a dividend. So that leaves Silver's E&P at $80,000. Letter D. Silver distributes the land, held as an investment, fair market value $54,000, basis is $62,000. That will change. This is now lost property. Basis is greater than fair market value. Assume the corporation has $76,000 accumulated E&P, no current E&P. So silver amount realized 54,000, basis is now 62. There's a realized loss of 12,000. Recognized loss will be 0. There's dividend income, 54,000. Because remember, there's 76,000 of accumulated E&P. Basis in the land, 54,000. Silver's E&P, 76 minus 62, because silver can subtract the greater of basis or fair market value to compute earnings and profits, which is now $14,000. And finally, letter E, silver decides to distribute equipment used in its business. Equipment has a $14,000 market value, a $1,200 adjusted basis for income tax purposes, and a $5,200 adjusted basis for earnings and profits purposes, because it's being depreciated at a different rate for income tax purposes and E&P purposes. When the equipment was purchased 4 years ago, the original fair market value was $18,000. Assume the corporation has $76,000 of accumulated E&P, no current E&P. Okay. Silver's amount realized, $14,000. Basis is $1,200. So there's a realized gain based on the taxable income basis of the property of $1,200. That's a realized gain of $12,800. Realized gain for earnings and profits, that same $14,000 minus the $5,200 E&P basis, $8,800. There's dividend income, it's $14,000, fair market value of the equipment received. Heather's basis in the equipment, fair market value, $14,000. Silver's E&P, $76,000 was where it started. We had the $14,000 dividend, and we must add back the E&P gain of $8,800 for a total of $70,800. Problem number 40. Lime Corporation with E&P of $500,000 distributes land worth $300,000. Basis is $350, more lost property. Distributes that to Harry, its sole shareholder. The land is subject to a liability of $120,000, which Harry assumes. So what are the tax consequences to Lime and to Harry? This time we're not going to have A, B, C, D, and E, just one set of facts. Market value of the land is $300,000. Amount realized is $300,000. Basis $350. So there's a realized loss of $50,000. Recognized loss of 0. Cannot recognize that loss. Harry's dividend income is the $300,000 value of the land minus $120,000 of liability that Harry assumed. That's $180,000. Harry's basis in the land is at $300,000 fair market value. Lime's earnings and profit started at $500,000. We will drop it by the greater of basis or fair market value, which in this case was basis of $350,000. But then we have to add the $120,000 of liability that the corporation transferred. So Lime's E&P at the end is $270,000. Constructive dividends. These are interesting. They can occur anytime a shareholder receives an economic benefit from the corporation. Examples include sale by the corporation at a price below market value. So the corporation is selling inventory at $100, but shareholder gets it for $80. Well, maybe that's a $20 dividend. Purchase by the corporation at a price above market value. So the corporation buys the stockholder's property at more than its market value. The difference, again, could be considered a dividend. Loan from the corporation to the stockholder at below market interest rate. Probably the IRS's favorite, a salary to the shareholder employee, which is in excess of what is reasonable. All of these things can be structured as a constructive dividend. Now, I will say no shareholder ever set out to receive a constructive dividend. These are things which the IRS comes in later and says, hey, wait a minute, that's not the transaction that you are claiming it is. That's not a legitimate sale or purchase or loan or salary because the market values are different from what you paid or received, as the case may be. So we're not buying it. We're going to call that difference a dividend. And I think, again, the one you hear about the most is that last one, unreasonable salary. You're in the same business as 5 other businesses in your town, and no other business is paying their owner that kind of a salary. We think that is a transfer of earnings and profits. In other words, a dividend. You wanted to call it a salary because salaries are deductible. Dividends are not. So you see that a lot. Finally, stock dividends. These are fun. We talk about them in Tax 1, and there's really not too much that is new, but it is covered in Chapter 5, so let's revisit it here. They are not taxable. The Supreme Court said no taxation if all you're getting is more shares of the XYZ Corporation for your current shares of the XYZ Corporation. And everybody else is also getting more shares of the XYZ Corporation, then your percentage ownership isn't changing. And so the Supreme Court said, no, Congress, you can't tax that. Congress did say originally that stock dividends should be taxable, treated like cash dividends. Supreme Court said, no, it's not income, does not meet the definition of income. And therefore, Congress, you may not tax it. But if you give stockholders the option to receive cash or some other property instead of stock, well, now if you take the cash, clearly that's a dividend or the other property. If you don't take the cash or other property, well, then other stockholders did, so your percentage ownership in the corporation went up as a result. So either way, you've got yourself a dividend. So it's very unusual for a corporation to do a stock dividend and then give stockholders the option to receive cash or other property. That'd be crazy. All you do is make your stockholders mad at you, which is never a good idea. The other exception is if the distribution is disproportionate. I don't think we covered that in Tax 1. If the distribution is disproportionate, then by definition, your proportionate ownership has changed relative to other stockholders. Why the other stockholders put up with that if you suddenly get a bigger proportion, I don't know. But if it's a disproportionate distribution, then you are not going to get the non-taxable treatment. If it is proportional to all the stockholders, well, then there you go. That's really just dividing up the pie into more slices. Everybody still has the same fraction of the corporation, so not taxable. The basis of the stock received, this we did cover in Tax 1. You're going to reallocate the basis of the original shares to the old and the new shares. They are the same class of stock, so you just got more common shares for your common shares, and just prorate based on the number of shares. All common shares are alike. If it's a different class of stock, well, now you've got to prorate based on fair market value, and that could be tricky, especially if you're dealing with not publicly traded shares. But that's the rule. So if you're now getting preferred in addition to your common, or you're getting common as a dividend for your preferred, then you're going to have to figure out what the relative fair market values are of those shares and work with that. Holding period of the new shares includes the holding period of the original shares because this is a non-taxable event, and therefore you're going to treat the new shares as essentially extensions of the old shares. It's the old rule that I told you back in Tax 1, holding period follows basis. It's 4 words, holding period follows basis. If the basis of the asset you just acquired is determined by reference to some other basis from some other asset, then holding period includes the holding period of that prior asset. And that would be the case here. Problem 48. Your client bought 10,000 shares of Grebe Corporation stock 2 years ago for $24,000. Last year, Jacob received a non-taxable stock dividend of 2,000 shares in Grebe Corporation. Again, let's assume same class of stock for both. In the current year, Jacob sold all the stock received as a dividend for $18,000. We're supposed to compose a letter to Jacob explaining what happened. Well, let's not compose the letter, but here's our notes for what we tell Jacob. First of all, 2 years ago, the shares, it was 10,000 shares with a basis of $24,000 on a per share basis. That's $2.40 a share. Then last year, we had the stock dividend, 2,000 shares. So now we have 12,000 shares, but the basis hasn't changed. That was a non-taxable event, that 2,000 share stock dividend. So it's still a basis of 24,000, and now the per share basis is $2 per share. So 12,000 shares at 24,000 used to be 10,000 shares at 24,000. Jacob's amount realized when he sold additional 2,000 shares was $18,000. His basis in those 2,000 shares at $2 a share is $4,000. So he has a realized gain of $14,000. And even though he just got those shares last year, and we don't know when last year, but could have been late last year and early this year, doesn't matter. It's going to be a long-term capital gain because he's going to treat those shares as if they were acquired 2 years ago. And that is it for the second Chapter 5 video, which means we are done with Chapter 5. Chapter 6 is next.